Today, we want to talk about what we call partial withdrawals. You'll recall in a previous recording that we talked about withdrawals from particularly Universal Life, where you can actually make a withdrawal, 5,000, 20,000, whatever that number may be. And I indicated to you that the difference between the adjusted cost basis and the amount of money that you're actually withdrawing, okay, that will be fully taxed. So if your adjusted cost basis is 20,000 and you decided to take a full withdrawal, so you cashed in the whole policy, let's say it's got 50,000 of cash sitting in there, that $30,000 difference, of course, that will be considered a full withdrawal and therefore will be taxed accordingly. But many times what happens is people don't want to make a full withdrawal, and they just simply want to make a partial withdrawal. They just want to take out a certain amount of money for whatever purpose that they may need. And so therefore, we need to take a look now at is what impact does a partial withdrawal have on the actual taxation of the cash that's being withdrawn. So because it's a partial withdrawal, then we have an adjusted cost basis will be a prorated adjusted cost basis, okay? So it's not the full ACB. We'll have to prorate that ACB to reflect that partial withdrawal. And the formula essentially is prorated ACB is the amount of money that's actually withdrawn divided by the actual cash value that's sitting in that policy at that time, and the original ACB, okay, because that original ACB. So this example that I have here on the board, we've got $10,000 that the client wishes to take out, okay, so that's the partial withdrawal. However, she's got cash surrender value of $30,000. In other words, she doesn't want the entire $30,000. All she's saying is, I really would just like to have $10,000 for a holiday, whatever the purpose may be, okay? So the amount of withdrawal is $10,000. The cash surrender value is $30,000. The original ACB for the full withdrawal was $20,000, okay? And so if you remember, the difference between the $20,000 and that $30,000, if it was completely taken out, complete withdrawal, that $10,000 would be fully taxed. But because we're not really taking out that entire package, we're only taking out a portion of that, therefore it will be prorated. So the $10,000 amount withdrawn divided by the $30,000, which is the cash surrender value, times the original ACB, the full ACB. So now the new ACB, the prorated ACB, is $6,666. Okay, so there's your new prorated ACB. So once again, we go back to our formula of policy gain is now the amount withdrawn, again that 10,000, minus the prorated ACB, not the full ACB, but the prorated ACB. So we take our 10,000, take out the prorated ACB, which is $6,666, and so therefore we now have a policy gain of $3,333. So they will receive essentially T5 basically from the insurance company showing $3,333 of actual gain, and they will then put that on their income tax form, and depending on their marginal tax rate, MTR, the marginal tax rate. So let's say they were in a 30% tax bracket. 30% of $3,300 is $900. So here's your money basically. Okay, so that's how it works. Okay, so this is a very important formula to remember, because most times people do not actually cash their entire policy in. They just simply want a certain amount of money to meet an emergency, pay whatever, holidays, or pay tuition fees, whatever. That need is there, but they still want that coverage. So they will take advantage of that partial withdrawal. But because of that, then we do have a partial ACB as well. So factor that in. Now, most of the times we think of withdrawals as an actual withdrawal. In other words, send me a check for $10,000. Well, that's the obvious thing. So it works right here. Okay. However, there's also another one which you must be aware of, and that is a reduction in coverage. So let's say that you had a $500,000 policy, and then for whatever reason you decided you're going to reduce it to $400,000. Well, if you do the math on that, you'll see that there's been a 25% reduction in the coverage. So you went 500 down to 400, so you have a 25% reduction in coverage and everything. That means that the ACB will also be reduced by 25%. Okay, so therefore, once again, we can have a prorated ACB simply by reducing the actual coverage. So by reducing the coverage, reduce the ACB, and therefore it will throw up a gain. So even if you didn't actually make a withdrawal, but it will throw up a gain simply by reducing the coverage. And that ACB being reduced by 25%, that means that there will be a gain of some sort. So again, you have to do the math on that and see how much of a gain would be. So moral story, basically, at the end of the day, is that there are two ways that you can have a partial withdrawal. That is an actual withdrawal itself, okay, that you're taking the money out, and a reduction in the coverage will also give you a prorated ACB. The other thing we have to look at is, well, what if I don't make a withdrawal? Okay, I don't want to turn around and pay the tax and everything else. So what's the alternative to all that? So everybody thinks, well, I'll just borrow the money from the insurance company because I have $50,000, they say, sitting in there. I'll collateralize my policy, take my $10,000, and everything will be wonderful. Not so. Okay, the actual fact, the taxation of policy loans will be treated as if it was a withdrawal. So even if you turned around and you withdrew $10,000, you are going to have a taxation similar to what we've just figured out right here. So in other words, a loan does not negate the taxation issue. The loan will be considered and will be treated as if it was a withdrawal. And so therefore, once again, you'll have the exact same issues as you had before, okay? So a loan is treated really as a withdrawal, giving you same scenario as we just finished talking about, okay? Now, in terms of a loan, there are a couple of things you should be aware of. If you borrow the money to invest, in other words, you invest in your company or you invest in buying stocks, bonds, whatever it is, in other words, you're investing to earn money and everything, the actual interest on that loan will be a deductible expense, because under the Income Tax Act, if you invest money to make money, basically, then obviously it will be a deductible expense. The interest component will be a deductible expense. Okay, so the end result is that business people, for example, may have these kind of policies on the key executives and everything, and then they may need to access the cash that's in the policy. They will borrow that money, because they're borrowing the money, say, to buy a piece of equipment or whatever, but they're using it for business purposes. Then the interest that is charged on that particular loan will be a deductible expense as well. Also remember that, and by the way, on that deductible, if you're only using the money for personal use, then obviously there's no deduction on that interest. So personal use loans, that will not be, it has to be done for business purposes to generate future income and so on and so forth. Okay? The other thing to remember is that if the loan is ever paid back, so the interest is paid, the loan is paid back, because remember, when you took that money out, the ACB dropped. Okay, it dropped. And now, let's say you decide, okay, I'm going to pay it back. So you pay it back, the ECB will go back up again. Okay, so basically paying the interest and paying the loan back will increase your ACB. Taking out that loan, paying interest on that will reduce the actual amount of your ACB. But if you decide you want to pay it back, then of course the ACB will be increased as well. Okay, and also, if in fact you did pay tax on that loan, then under the Income Tax Act, because you now have paid back the loan, you will actually get a credit on that loan. So in other words, you're basically, you might say, reversing everything as if nothing had actually happened. Okay, but that's another way of looking at loans, withdrawals, and everything and primarily used, of course, in universal life is where this is really far more effective than whole life par or non-par. We'll see you next time.